Stefan, thanks for that very, very clear presentation of something which is a simple idea, but it's not quite as simple as perhaps you made it sound. So transitioning from your talk to a panel which you have set up of people who have actually implemented your system. The audience is clearly interested in the implementation. Does it work? What are the issues? And so on. So we have two people from practice, and we also have a person, another academic from Mannheim. Let me introduce each of the terrific panelists that you've got together. First of all, Teresa Alanda-Verda, who is the CO2 Strategy Manager at Heidelberg Materials, probably better known still as Heidelberg Cement. Gunter Glink, who's an Assistant Professor for Sustainable Business Economics at the University of Mannheim. His research is at the intersection of management and sustainable technology, focusing on questions of cost and speed of decarbonisation. Beginning in the summer of 2023, Gunter is a climate fellow at Harvard Business School. Jochen Kortz is Vice President of Group Performance Measurement and Analytics at BASF. As Corporate Controller, he is not only taking care of the financial performance of BASF, he is also concerned with sustainability reporting and controlling at BASF. And someone who's a great supporter of CARE, Accountability in a Sustainable World Quarterly, Stefan Reichelstein, is the director of the Mannheim Institute for Sustainable Energy Studies, which addresses economic aspects of the transition to a decarbonized energy economy, with a particular focus on the timeliness and cost effectiveness of this transition. He currently also serves as the faculty director of the Sustainable Energy Initiative at Stanford GSB and as a senior fellow at the Precourt Institute for Energy at Stanford. Now, just before I ask some questions of the panelists, I'd like to give you some thoughts about why we, the editors and organizers of the journal and the conference, thought that this topic was important, that we should have exposure in our conference and the journal. The answer is perhaps obvious. Understanding and reducing carbon emissions is the focus of much of the debate about combating climate change. And it's at the core of government policies. For example, the Paris Agreement, the EU carbon tax, developing a carbon trading system, etc. Accounting, or more generally measurement and accountability, assurance of the measurement, must be at the core of these efforts and discussions. For these reasons, Stefan has just given the plenary on a system of accounting for carbon emissions, and we will now have the discussion of details and issues with implementation. So the first question, and I'd like all panelists to think about answering this question, ESG-oriented management and ESG ratings appear to be very much in vogue these days. In the current interest in corporate carbon accounting, or is the current interest in corporate carbon accounting just one piece of that movement? Or is there more to corporate carbon accounting and reporting than just being part of general interest in ESG? Perhaps I might start with you, Stefan, as we just heard you in the plenary, and it seems appropriate for you to start the discussion.
Sure, be glad to. So at least to give you my thinking on ESG to carbon accounting, we obviously hear a lot these days about ESG-oriented management and companies disclosing that they take ESG criteria seriously. I think in almost all cases where I've followed these developments, the E part has been prominent, and then among the E part, the C part, C standing for carbon, has usually been a major component of those activities, metrics that companies track. I think it's overall not surprising because most of those ESG variables share with the carbon problem the one issue that private and social costs of companies' actions frequently don't coincide. So the famous, what economists refer to as external costs. And I think that binds them together in terms of monitoring these variables in addition to financial performance. That said, I think the carbon problem is arguably the most urgent among all the ESG problems, just in terms of the amount of time that the world has left. And I think another distinctive feature here about carbon is that it's, by comparison with several of the other variables, relatively easy to quantify and measure. That's, I think, why many companies, when they do embrace, say, ESG variables in their pay for performance schemes, typically have something related to carbon in it. So that's sort of my take on how those two relate to each other and whether carbon and carbon emissions sort of play a special role in this.
Perhaps I could ask you, Teresa, to follow up with the Heidelberg
Yeah,
perspective.
sure. I mean, definitely, the ESG actions are increasingly important, not only for the investment decisions inside the company, but also outside a corporation. So we have seen that interest rates in the last years among our stakeholders, financial analysts, rating agencies. So as a whole, ESG is, as you clearly mentioned, is a bigger item nowadays that everyone would like to be part of. But it is true that one of the biggest part is the climate part, and carbon accounting, a corporate carbon accounting, it's key in order to understand where you stand and where do you want to be. And I think for us, it's one of the key tools to really look into the long-term perspective and how can you deal with the problem that we have currently in terms of climate change.
Perhaps the BASF perspective, Joachim?
I would agree to Teresa that the interest in ESG overall is increasing heavily. However, it's not a fashion; it's an entrepreneurial necessity. We are providing data on ESG since 2007, when we published our first eco balance at that time. Now, particularly to climate protection, actually it's the urgency, but it's also the impact. So climate protection is essential not only for our planet, it's also essential for the companies in their business transformation, which is ahead of us or where we are in the middle of it. So this will certainly be a game changer for the industry. And in the companies, we need to steer the carbon emissions systematically and consequently. And in order to steer, you need the transparency based on clear rules and standards. And in order to generate this transparency, you need data, but you also need a robust accounting.
Gunter, maybe you'd like to follow up.
Sure. First of all, thank you so much for being on the panel, and I definitely agree with everything that's being said by my fellow panelists just now. I would add two further ideas, suggestions, or differences between carbon accounting and ESG management. And one is that the objective of carbon accounting is different from what ESG metrics today measure. Carbon accounting seeks to provide a reliable or faithful representation of the greenhouse gas emissions that are associated with the firms and their products. So the reported emission numbers merely depict but do not interpret emissions. In contrast, most ESG metrics seek to capture the impact of ESG matters on the financial performance of a company. So as such, they include a interpretation of the ESG metric provider and the interpretation of how the ESG matters affect the company. That's the first comment. And the second one is that I would essentially reiterate what you, Peter, said, namely that understanding and reducing carbon emissions is at the core of climate-related government policies, and carbon accounting has now become part of the intensifying effort to mitigate climate change.
So it's clear that things are happening. It's also clear that things must happen. It's urgent. Is it clear that good accounting for CO2 emissions will be perhaps the tool, the meaningful tool in reducing global emissions? Do you believe that this is an area where good accounting will and should have real effect? Who should? Like, maybe Teresa.
Yeah, sure. Well, the thing is, first, before to start talking about reductions, we need to understand where we stand. And I think this is the power of carbon accounting. Because if we are able to really narrow down where are our emissions coming from, where they're generated, how they come together within our production processes, then we have the tools in order to reduce our emissions and finally our climate impact. So yes, a good and stricter accounting of carbon, it is necessary, but it's not only for the reduction, it's also for the step previously, the reduction, that will allow us to see where can we tackle those emissions, where are the biggest part. And in terms of the effects of carbon accounting, I think it's very important, it was mentioned before already, to have a clear understanding. What is the standards? What are the rules? What are we talking about when we need to account for carbon? That everyone has a common understanding that the accounting of carbon in one product is not an individual assessment, is rather a well-known and accepted set of rules. And finally, that this information is transparent, because I think that is one of the key challenges in the future. So when we talk about emissions, not only from our own operations, but also within our value chain, transparency and credibility.
Okay. I wonder if you might follow up on the way that good accounting has maybe changed the things that you've done at BASF.
It's a basis, again, like Teresa said, we first have to get grip on where do we stand with regard to the emissions. And I would say it's not about a carbon accounting, it's about the carbon accounting. And the carbon accounting means exactly that there is not too much room to maneuver. It needs to be clear, solid rules, standards, and that we are certainly working on. This needs some further progress. Secondly, you need robust processes within the companies in order to collect all the data, bring them together. You need a mechanism. You need IT tools. You need automation, and of course you need also the know-how to bring across and also the messages. And I'm not only looking to the accounting, but also, let's say, to the controlling, to the business analytics part, because this will be also key in order then to steer reduction accordingly. And also, and this is new for at least for me, coming from a financial world, you can also with the accounting determine new business models. You can change your products which you are selling to the customers, because customers will require different products. So you are part of the transformation as the one who is, let's say, the lord of the figures in terms of the accounting.
Good.
Peter, if I can just
follow up on the real effect. Oh, sorry, Stefan. Go ahead.
In after these two, I think that's exactly the way things are going, not only at BASF and at Heidelberg Materials, but at a lot of companies around the world. My personal read on this is this has come about because of the many net zero pledges that companies have issued in the last number of years. And with that came then also a sense we need to become more proactive in terms of measuring what our carbon footprints, be it at the product or at the corporate levels, are. It's no longer good enough to just sort of wait from numbers that some outside consultants based on industry-wide data give us. We need to understand ourselves where the emissions are, where they can be reduced. And that means measurement and reporting is now going to be more active at the company level than it used to be. That's my sort of general read on what has been happening.
Any final word on the topic, Gunther?
Sure. You also ask whether good accounting can have real effects and whether it possibly will be the tool now that will finally deliver substantial emission reductions. And first of all, good accounting for CO2 will enable companies to act on climate and report their progress in a more reliable, transparent fashion. We just heard that from all the other panelists. And earlier studies also show that CO2 disclosure mandates can lead or has already led to significant emission reductions among those companies that have been subjected to the mandate. At the same time, I would caution now placing carbon accounting as the only tool that we have. I would rather see it as a complement to other policy mechanisms. For instance, the EU carbon border adjustment mechanism requires a methodology for identifying the carbon footprint of the imported products. That's again where carbon accounting would come in.
Which that answer leads me immediately into a different question or a related question. You, Gunther, have written quite a lot about what you perceive as deficiencies in the greenhouse gas protocol as a framework for corporate carbon reporting. Can you give us a brief summary of your concerns?
Sure. So maybe for everyone, the greenhouse gas protocol is the most widely used methodology for determining corporate greenhouse gas emissions. Effectively, all public and private companies rely on this methodology to determine their corporate emissions. In my mind, the corporate greenhouse gas protocol has three main deficiencies that then lead to several symptoms that have also been criticized before. And the three main deficiencies are first that they establish no unique attribution of emissions to firms. That in turn leads to double counting, for instance, of emissions across firms. Second issue is that the greenhouse gas protocol makes no clear distinction between emissions that have already realized versus emissions that are estimated to have occurred versus emissions that are expected to occur in the future. It's essentially all viewed as one and the same kind of emissions, put in the same pot. And then the third key problem is also something that Jochen has briefly mentioned. It's namely that the protocol, even if companies stick strictly to the protocol itself leaves a lot of leeway for companies to choose the scope, the approach, and the methodology for determining the emissions. Now, all of these three main deficiencies lead to emissions being counted multiple times by different companies. Then also that reported information is essentially biased or perceived as incomplete, incomparable across companies or across periods, intransparent, and also inaccurate, simply because in all these estimates, there's then a lot of leeway for how you can come up with an estimate. Now, overall, I'd say the greenhouse gas protocol does generally not produce information that reliably or faithfully represents the actual changes in atmospheric greenhouse gas that are associated with a firm's economic activity. Or in other words, it remains unclear from the numbers that a company report what a firm's contribution to climate change has actually been.
Yeah, I understand your critique. Many observers, including Stefan on the panel, has argued in favor of a carbon accounting system that is based on fairly broad notion of responsibility, being the key word, for carbon emissions. Companies are responsible for all emissions that are embedded in the products and services they provide, not just their own direct, that is Scope 1 emissions. If we take a narrower view, that is, a business is only responsible for its own direct emissions, the accounting becomes much simpler. In your mind, would it be more appropriate and more transparent if companies confined their carbon reporting to their direct so-called Scope 1 emissions?
Yeah, if companies focused in their reporting on direct emissions, then the accounting would indeed become much simpler. The information quality of reported direct emissions is usually also much higher than the quality of indirect emission disclosures. The reason is that firms can typically determine direct emissions based on physical quantities like liters of fuel consumed and the carbon content of these chemical compounds. While for indirect emissions, it's more of an estimate of how much dollars or how many dollars did I spend on a particular item, and what do I think is the emissions that is associated with $1 spent on a particular item. However, companies, like consumers, are widely viewed as being responsible for the goods and services that they procure. And a focus on direct emission would also enable firms to reduce their emissions by outsourcing carbon-intensive production processes. Now, proponents of a more narrow responsibility perspective often base their arguments on the complexity of estimating indirect emissions and the uncertainty that is associated with these estimates. A solution to that could be that emissions embedded in products would be transferred along the value chain, similar to what Bob Kaplan and Karthik Ramana suggested in their papers and also in their presentation. As such, then companies do not need to make their own estimate of upstream emissions, but can rely on the information provided by their suppliers.
This is at the heart of the carbon accounting system that Stefan talked about in the plenary, and we're going to continue to talk about now. I wonder if other panelists have a comment on this, or a need to elaborate, or something I want to say at this point, or can we leave that till later?
Let me perhaps just
maybe I'll just quickly add that I didn't want to exclude
Teresa, go ahead. I think Teresa is ready to jump in.
I just wanted to have a comment because it is true. So for companies, always to look into our direct emissions is where we have the more visibility. So it is easier to know what are the products that we are using for the production of our materials. So it's definitely an area where companies could have a better overview and a better result that could be transferred later on to the value chain. However, I will not take completely out of the scope 2 and scope 3, the indirect emissions, because this gives momentum to the full value chain. I think we can make a distinction between the responsibility of the emissions, but we should still look into the full scope just to ensure that we are mitigating the climate, because when we shift the attention and we say, okay, now scope 3 is not longer relevant, it might trigger another problem, that there is no enough incentives, or there is no enough push for the whole industry to move forward. So we need to still have a look into the value chain emissions, but definitely where we can manage is the scope 1 emissions, or direct emissions.
Yeah, I would agree to it with regard to the influence we have on scope 1. This is certainly, from a priority point of view, the first thing to look at, to look in your own emissions you are generating. However, and especially if we look to the value chain and you want to be a good supplier to your customer, it's not enough to look to your own emissions. You also need to look to the entire value chain, at least cradle to gate, in order to provide your customer reliable data. And at the moment, of course, these are two different qualities which we are facing, which we are adding to one product carbon footprint, for example. But this means there's a lot of things which need to be done rather on the indirect emissions in order to bring them along the value chain so that at the end the final customer gets a full transparency in a decent quality.
Stefan, did you want to add a word?
Quickly around this off, I think Teresa sort of dropped in my mind, all important point and term here, and that is ultimately the incentives to manage and reduce emissions. Whatever a company may come up with in terms of this is how we measure our product or our corporate carbon footprint, the immediate next question must be, so do you then also, are the incentives aligned for this company to reduce emissions, either directly on its own scope 1 emissions or working with its suppliers in terms of the carbon that goes into the inputs that the company buys? And I think the whole discussion sort of about the greenhouse gas protocol is sort of a little, I would say, held back by the broader consideration. So what are companies trying to do? What are they trying to get out of these metrics in terms of management and going forward? It's undisputable that at the end of the day, it is the sum of all scope 1 emissions across the economy that determine total emissions that go into the atmosphere. But that makes it still a rather incomplete metric at the company level, in particular when you look at things like outsourcing carbon-intensive activities, something that would not happen if you took an upstream scope 3 perspective, as several of you already indicated. So I think what is sort of good and a good metric for carbon footprints depends very much, are we going down the product route or are we going down the whole corporate carbon footprint route? And that's when we also get into issues of double counting. I think a system of product carbon footprint measurement systems done properly should not entail any double counting. And I think that's one of the promises of doing so. All right, I'll stop here.
Okay. Thanks, Stefan. Can we back up just a little bit? To some, it's well known that the cement industry is one of the biggest sources of CO2 emissions. Perhaps, Teresa, you could give us a thumbnail as to why that's the case. And then related to the previous point, particularly Stefan's summary, have there been recent changes in how Heidelberg assesses the carbon footprints of your products and why?
Yeah, thank you very much. So, well, yes, as you mentioned, it's always well known that the cement industry is one of the biggest contributors to our CO2 emissions globally. So every time it fluctuates between 7 to 8%, the global contribution of the cement industry. And this is due to the fact of our production processes. So if we would like to break it down in small pieces, is for the production of cement, we need raw materials like limestone. And we need to calcine those raw materials at very high temperatures. Therefore, we need a lot of fuels within this process. So the raw materials by itself, they have already some carbon content in it. So when we calcine them, this carbon is released. This is one part of our emissions that unfortunately is very difficult to abate because it's just the composition of the material itself. You cannot change the composition. And then the second element is the fuels that we use in our kilns in order to create this process. And this is a bit more, let's say, in our hands to try to reduce. Okay, we can go in the past. There was, of course, a lot of fossil fuels. These actions are changing. So we try to use more alternative fuels and also with biogenic content that there is no CO2 release in the atmosphere or not as much as in the past. And what we were also looking at is, okay, so we know that we have a high footprint in the climate emissions. Therefore, we need to do something. But as we mentioned before, the first step is to understand where we stand. So what is exactly our CO2 status quo, let's say, to really check all our processes and ensure that our processes are following the flow of the carbon. So meaning looking from the very beginning, from the raw materials perspective, not only the material itself, but also the activities associated with what you need to do for the processing of the raw materials, how you are transporting the raw materials to the main facility, to burn the materials, what type of fuels are you using, in which amount, etc. So once we have the picture clear, so what are the elements of your production process, you can have the CO2 associated with it. And therefore, you can set up the plan to reduce your emissions. And in Heidelberg Materials, what we have done in the last couple of years in terms of our CO2 reduction strategy is once we have the picture clear, then we engage with all our countries worldwide. We are present in more than 50 countries. And to sit down and say, okay, well, what can we do to reduce our emissions? Also based on the local requirements and also the opportunities. We know there is more pressure in Europe. It's not the same pressure in Asia, for example. Also availability of the materials is different. But well, we take into consideration all these different aspects. We have really a global exercise between our country groups, also global leaders at the group level, our technical departments, procurement, commercial, and eventually as well the management board include that the plan on the long term, our CO2 strategy to reduce our climate impact, it's really part of overall discussion between country group and the management board. And then when this plan is set, so it was approved by the board, and then now the plan is to keep tracking and see that we are fulfilling our expectations, right? So that is mainly what we do in terms of our CO2 strategy. And the final part of your question was regarding the products and if we have changed a bit our calculation method. So we are a heavily regulated environment in the cement industry. So there is a guidance for the Global Cement and Concrete Association that really defines what are the aspects that you need to track for your CO2 emissions. But when it comes, this is only one part because the Global Cement and Concrete Association only look into the clinker level, so it doesn't go all the way down to the product level. And the product level is what we are doing, let's say, in-house. When we review what is the content of CO2 in each one of our products, this is something that is not heavily regulated, by the GCCA, by the Global Cement and Concrete Association, but it's something that we are doing, let's say, on-house. And this is how it has evolved along the years.
Any comments from the other panelists on these thoughts of Teresa's? I'm particularly interested in the role of regulation, for example. How does that
Perhaps
affect
one aspect I thought in the case of a company like Heidelberg Materials, one advantage that the company has when it comes to the whole notion of what is our corporate carbon footprint, because yes, you have different so-called cementitious products that are basically different cement recipes that you have. You can nonetheless aggregate relatively nicely at the end of the day. And my understanding is that's how some of your incentive mechanisms and interim goals for CO2 reductions are also stated, is that you can say, let's take the carbon footprint of individual cement products, see what we have produced and sold of these, and then basically give a figure that is the carbon intensity per ton of cementitious material. So in other words, an aggregation down to one number. And if I recall correctly, one of your interim goals is to say by 2030, we want to get down to a number around 400 kilograms of CO2 per ton of cementitious material. That's, of course, a nice sort of situation to be in if you can sort of really ultimately condense into one product group. Yes, you have different recipes, but you can basically add those up so that you have a very compact and clear metric as to what the goals on average are going to be.
No, yeah, that's absolutely correct. What you mentioned, Stefan, and that is only possible if you have the overview of where are your emissions coming from and how you can allocate that to the products. But yeah, to have for us to have one single target in a product level, let's say the 400 that we would like to achieve, well, that is a clear path and a clear target for us. Yeah.
Well, Kim, the chemistry industry, and from your point of view, BASF, is another major source of industrial CO2 emissions. Can I ask you the same question as I asked Teresa? Does BASF have a CO2 strategy? And what are the recent changes that you've been making as to how the company assesses the carbon footprint or the carbon footprint of its products?
Yeah, of course we have a strategy, and we even have in our corporate strategy, in our claim, the wording, we create chemistry for a sustainable future. So we have to deliver here. And indeed, the chemical and including the petrochemical industry counts for 6% of the global emissions, and therefore is a significant contributor of greenhouse gas emissions. And even further, if you look to the usage, 95% of all manufactured goods are relying on chemical products. So chemistry, therefore, is at the foundation of almost any product. And this means we have a responsibility as chemical industry to reduce the greenhouse gas emissions significantly, because you cannot substitute them at big scale. Now, our CO2 reduction strategy first is based on clear targets. We want to be carbon neutral in 2050. We want to reduce, and we will reduce our greenhouse gas emissions. Now I'm talking about scope 1 and 2 by 25% until 2030, which is then compared to a base year 1990 already 60% less. So this is already in our genes to reduce carbon emissions, and the low-hanging fruit already have been captured, also optimizing the emissions for economic reasons. Now, to reach these targets, we have a pipeline of measures which are and will be systematically implemented. Chemistry is energy intensive, so BASF has already secured huge sources of renewable energies. As an example, for example, we invested in a 25% share in the world's largest offshore wind park in the North Sea with partners, and we are securing 50% of its production. This is also needed and has to continue because energy is key, and because we also have to change technologies fundamentally in order to use renewable energies instead of fossil energy carriers. For example, one of our product lines is a steam cracker, and as you hear, with high temperature, raw oil is cracked, and in future these crackers will be fed by renewable energy, and therefore you have to switch the technology, for example, to an electronic, so to an e-cracker, or steam is another carrier of energy. We need e-heat pumps in order to produce steams, or to produce hydrogen out of electrolyzers, which again stems from or is fed by renewable energies. So this is already telling you that this is a major endeavor to transform the entire chemistry, and we are in the middle of this process. Regarding the accounting processes, what you mentioned, we are reporting greenhouse gases since 2007, and this we improved year by year, but since 2020 we report the greenhouse gases under reasonable assurance audit standard, and this has been a game changer again, because basically we have the ambition as BASF to have the entire reporting as robust and as automated as we know them from for the financials. And that's relating to corporate reporting, like Stefan made this difference between corporate reporting and product reporting. And we are well advanced with regard to the calculation of product carbon footprints.
Is this the SCOTT, SCOTT tool to which you're referring?
Indeed.
Say a little more about that and how that was.
I'm happy to do so, because this is close to my heart, and really has been something new for at least for the chemical industry. So SCOTT stands for Strategic CO2 Tracking Tool, and it's a self-developed digital solution to calculate product carbon footprints, the so-called PCFs, according to a method which is compliant with the greenhouse gas protocol, with the ISO standards, and which calculates the product carbon footprints of BASF's entire product portfolio. So we are talking about 45,000 different chemical products which we are selling to our customers. And we had the ambition, like accountants do, for example, for product costing, to do this in one run. So to have all the information together globally, all the supply chains, and calculate these carbon footprints. And when we started with this endeavor in 2019, we realized that there was no scalable digital solution suitable for chemical manufacturing on the market. Furthermore, what we also realized was there was not enough standardization, as I mentioned earlier. Also, there is a greenhouse gas protocol, and there are ISO standards in place, and even so-called product category rules for single products, which have been aligned between industry players already. Still, the room for interpretation in PCF calculation for chemical products was just too high to achieve a comparability of the results, which are decisive for our customers to make decisions. And on the other hand, as there was room, and we wanted to automate this whole calculation, we needed to tell to the computer what he needs to do. So a detailed set of algorithms, which made all the regulation more concrete, has been developed. And that's what we then called our methodology, our algorithms. This brought us in the situation that we have really an unbiased calculation, where not a product manager decides then where to allocate the cost or discusses with a life cycle assessment expert. Now, the good thing is we shared this methodology then with consultants, with industry associations, with peers, and got great feedback on this. And yeah, people said that's good that BASF is approaching this topic for the chemical industry. And meanwhile, this has been the foundation for a global chemical industry PCF standard, which is issued by Together for Sustainability, association of big global chemical players who are part of this. And also this association is then also reaching out to other associations, for example, for the automotive industry, in order to have then also for the customer industry this standardization, which is much more detailed as what has been there. Now, on the other side, regarding what's the effect, on the one hand, we could reach out to all our customers and tell them exactly what our carbon footprints are. With one remark, we used, of course, our primary scope 1, scope 2 emissions, but we had to use scope 3 emissions mostly from databases, average data, and of course this is unsatisfying on the long run. So we use then also the methodology which we developed, and also the software which has been developed by other companies based on our methodology, to approach our suppliers and to request from our suppliers individual supplier-specific product carbon footprints for their products, for our raw materials, which we can feed into our PCF calculation. And that's certainly nothing which will happen within a year. There you need a bit more time, but we are well underway. And yeah, that's also change management. Change management across the industry, certainly also change management inside of our company, because a product carbon footprint makes an emission touchable. A product manager, a plant manager, a technology guy, a procurement guy can talk to each other, and they talk about one figure, like Stefan mentioned about Heidelberg Materials with the 0.4 target figure. This is something which is quite more touchable than 1 million tons of emissions emitted on a corporate level.
Very interesting. I find it particularly interesting that a lot of this is driven by customers. You kept saying customer, which is at least encouraging to me. It's sort of almost like everyone wants information.
And if I may add some aspect, of course, not all the customers are running to BASF to ask for low carbon products. This is something which is rather a discussion than something which is happening on the spot. But again, the customers will approach us to reduce carbon footprints, and they need to know where we stand. And this is now an advantage in the market if we can tell, yeah, you have a reliable figure which is certified by an external certifier. You can rely on these figures, and now we can talk about reduction by 10%, by 2%, or whatever, in whatever scale. And of course, the same we will do with our suppliers, and therefore we are keen to get the carbon footprints from them, not only to improve the quality of our product carbon footprints to our customers, but also to talk about reduction. And PCFs will be a buying criterion going forward. Once we have the transparency, how do you want to talk with your supplier about reduction of carbon emissions if you do not know where he stands, which was also pointed out by Teresa earlier.
Good. All right. You've been quietly listening here. I'm sure you have some thoughts on what Teresa and Joachim have been talking about.
Sure. Maybe just a small point here. So I fully agree with what the two said. What I find particularly interesting about the SCOT tool is this automated hierarchy of emission allocation, because that goes ultimately back to the old question in accounting: what's the cost of a product? There are many ways to allocate cost to a product, and so there are many ways to allocate emissions to a product. Now, what do we actually want to have as a product carbon footprint? How can we ensure that a product carbon footprint reflects the actual emissions that have occurred with the provision of a particular product? And that goes back to the allocation of a product, the allocation of emissions to a product. Like with costs, it will probably be very difficult to find one single source of a rule of truth that holds for all industries and all production processes. That's simply not feasible. But maybe we can find a range of accepted allocation rules. So companies have some leeway to adjust, to allocate emissions and influence the product carbon footprint, but not too much. And then if a company wants to depict to the outside that they're particularly concerned about or honest about their product, about the emission allocation to products, then they can come up with a optimized hierarchy of emission allocation so that a product manager cannot influence the emissions of a product simply because that emissions happen to be too high for a particular customer. Then the product emissions are what they are, and they come out of an optimized tool, and everyone can look at this methodology that the company can publish.
It's interesting. What you say applies just as much to allocation of costs for internal decision making, for external reporting, as much as carbon, right? I mean, it's the same kind of principles. Although I think I'm preaching to the choir here, Stefan would say exactly that, I believe.
Absolutely.
Stefan,
I think this is really the heart of the matter. What I call sort of the new carbon accounting here, which is done at the company level, at the product level, and then builds up to an overall corporate carbon footprint measure or multiple measures thereof. But the key thing is that it's done locally in a manner that is analogous to the way product costs are calculated. And the issues that all three of you a moment ago brought up, of course, we're very familiar with from cost accounting. And we know after decades of discussion, there is generally no such thing as the true cost of a product. There are reasonable and less reasonable ways to allocate overhead costs. And in the case of carbon, typically your scope 1 emissions, your direct emissions, are an overhead item. And so are heat and electricity, so scope 2 emissions. And you can have multiple reasonable allocation rules. They will ultimately shape how the different individual product carbon footprints comes out. But there are going to be limits to what is a reasonable allocation mechanism if you are looking for the causal relation between energy, between resources consumed and ultimately products being produced. So it has a lot of analogies to cost accounting, and I think that's a good news. The world should take advantage of that knowledge that has been accumulated there. That doesn't mean that it has to copy the rules of cost accounting one for one, but you can still take advantage of it. And it's also going to be very useful to the point that Jochen brought in, ultimately showing to our customers that if we say there are 400 kilograms of CO2 now in 1 ton of cement, this isn't a number that we sort of made up with some fancy calculation system. This is part of our regular systematic internal accounting system. It has been verified by an auditor, and the rules underlying it sort of pass the basic smell test that we have for other accounting procedures. If we have that, I think we've got a lot of structure already in place.
Just to add one point, Stefan, if I may, now with regard to the concern of there are different ways to allocate certain emissions. That's certainly true. However, we have also to take a look to the materiality. And if I take a company like BASF or other chemical companies, as well as Heidelberg Materials, I assume, regarding the materiality of the different ways to allocate, I would say this is limited. If you have a clear set of rules which you are applying and which, for example, also in the cement industry, others would also apply, then at least you have a common denominator, you have comparability on the one hand with regard to the customers, and on the other hand, it's anyway about reducing this these emissions, regardless if this is now for the one or the other product. And we have made an exercise on how much we could within our boundaries still have a different allocation, and came to the conclusion this is rather limited. And for me, the proof of the pudding was that now in chemical industry, other chemical companies could live with the approaches which we have developed. Would be different if they now would have come up with a completely different approach, and a lot of discussions would have taken place, which was not the case. And that's encouraging.
Unfortunately, we're down to the last 5 minutes. We could keep talking for a long time. I'd love to talk for much longer. May I just make an observation? I, as an interested insider, outsider, are very encouraged by what's being done by corporations, by the corporate world, on a voluntary basis. That said, I'd like to ask you your last question, but you can choose not to answer it and say your last final 60-minute thought that you'd like to leave us with. But given the amount of voluntary disclosure and these great systems that are being set up, what are your predictions about the importance of and the types of carbon disclosure mandates that are coming from regulators in the United States and in Europe? So I'll leave you to answer that question, or anything else that you think is much more pressing than that for the last minute, please. Teresa.
Okay, so I try to go quickly. So, well, there's already a lot of pressure for disclosure of our emissions. So when we look into the ESG ratings, you name whatever rating you want, everyone is interested to understand our emissions. So what is our big impact? Where are we? What are we doing to reduce our emissions? So I think disclosure and transparency is just getting more stricter and getting more drilled down. So in the past, it was fine to report maybe only your direct emissions, and now goes more along the way on your value chain and what are you doing. So what we see is just extremely interest increasing on transparency. But also the other challenge is not everyone on the other side of the ratings could make a distinction between the industries, because it's not the same when we look into the cement industry, when we look into the chemical industry. And those specifics sometimes are lost within the rating activities. I mean, they ask for a lot of disclosure, but the specifics of the industry sometimes are a little bit lost on the way.
I'm quite sure that from a regulator's point of view, there will be the request for scope 1, 2, and 3, and maybe even more strict scope 3 reporting than currently available, which puts pressure from my point of view in the right direction. Second point, what I expect is that the auditing goes stricter more into the financial reasonable assurance like audit, which also requires processes which are stable and so on. And what I hope is that regulators will not come up with disclosure requirements which are bringing wrong priorities to the companies, where they are busy with some kind of reporting which does not really help bringing down the emissions, neither to serve the markets, the customers, and so on, and contradict what's already made on a voluntary basis.
Thanks, Joaquin. Gunther?
Sure. I would add more of a conceptual perspective to the carbon disclosure mandates. And first of all, I think they will help in two important ways. First, one is that all subjected companies will now have to report emissions according to the same guidelines, rather than the guidelines being voluntary and generally emission reporting being voluntary. And then specific guidelines prescribed in the mandates will also improve the verifiability, neutrality, and completeness of Scope 1 and Scope 2 emission numbers. Now, at the same time, I would also say that the mandates inherit some key deficiencies from the greenhouse gas protocol, because when it actually comes to how to determine CO2 emissions, then the two mandates that point to the greenhouse gas protocol for how to do it. And the key deficiencies inherited are that the mandates do not establish a unique attribution of emissions to firms, and there will be an insufficient differentiation between emissions that have realized versus those that have been estimated to have realized and those that are expected to occur in the future. So with these deficiencies, the numbers that are being reported, from the numbers that are going to be reported, it will still remain unclear what the total changes in atmospheric greenhouse gas will be that are associated with a firm and its products. So it's going in the right direction, but there's still more to do.
Thank you. Stefan, you have the final word.
The final, fast, quick word. Yeah. So since you asked about a prediction about the US, my reading of the tea leaves is that we're not going to see, at least from the SEC in the US, more than we have seen in their exposure draft. In other words, yes, Scope 1 and Scope 2 is to be reported. 3 would be nice, but there will immediately be something like a safe harbor provision around Scope 3. But I think that's only part of the equation. I think the other part is exactly what we have been talking about here, that companies want to increasingly disclose information about the carbon footprints of products. Customers are demanding it, as we heard several times. And I think that in turn will have implications also, and we're seeing sort of court cases in a number of countries playing out, that companies say, oh, I would like to report a number, but I cannot make that up. So I better have a systematic accounting system subject to a certain amount of verification that will allow me to say the carbon footprint is X and I have achieved the following improvements. So think of this as a form of voluntary disclosure, but in order for your voluntary disclosure to be credible, you must also be able to back it up with the kind of in-house accounting system that we heard a lot about today. And that in turn will allow you to really go forward and say, look, this number, I didn't make it up. This is not greenwashing. This is something that I can back up with a systematic set of accounting rules.
Thank you all. It was a most enjoyable 60 minutes. I wish we had a lot more time. Thank you so much. I think the viewers are going to certainly enjoy this.